Hello everybody and welcome. Today we're going to learn about something called an iron condor. It's an option strategy that essentially chooses a range. So what do I mean by that? Well, if you're familiar with verticals at all, in this case the stock has essentially been going up for the last few months, and if you're a vertical trader, you might make a vertical trade that assumes the stock price is going to go up from here. Or if you're a contrarian like myself, you might say, hey, the stock price has been on a run for the last few months and I'm going to predict it's going to go down from here. Either way, a vertical is basically telling you I have to pick a direction. I have to decide whether this is going to go up or down over the next month or 2 months, depending on how long the trade is. But what happens if we get to a stock that looks like this? Okay, this has just been going up and down like a heartbeat for the last few months. And essentially, if we draw lines about where it's been about as high as here and about as low as here. So it's been in about the 140 to 180 range. Okay, so if I want to make a trade that essentially predicts that this stock price is going to stay within this range for the next 30 to 60 days, depending on how long I'm making this trade, how would I do that? That is where an iron condor comes in. So the way it works is we are combining two verticals. We are selling a call vertical, which means we believe the stock price will go down, and we're selling a put vertical, which means we believe the stock price will go up, which seems to make no sense, right? We're doing two things that are opposite to each other. Why would I ever do something like that? And that's because when we sell a call vertical, we're going to start at the high end of the range, which means up here. So we're going to sell a call vertical and bet the stock price is going to go down from here. At the exact same time, we're going to sell a put vertical with the assumption it's going to go up from here. And what that means is we expect it to stay within these two blue lines. That's an iron condor. We're selling the call vertical at the top side of this range. We're selling a put vertical at the bottom side of this range. And that creates something called an iron condor. So let's take a look and see how that looks on a trade page. Again, remember 140 and 180 are kind of our two prices we want this to stay between. So if I go to the trade page, open up this 42-day cycle right here, I've already done the homework for us. What this is remember I said we're selling a call vertical, believing it'll stay below this, and we're selling a put vertical, believing it'll stay above this. So I sell the 180 call, and I sell the 140 put, which means I want it to go up from 140, and I want it to go down from 180. And then what I do is I buy a strike just above the call and one just below the put. And that creates a vertical. This now becomes a $5 wide short put vertical. Same with this, a $5 wide short call vertical. And when I do that, I'm collecting $1.26 for this trade. Now remember, this is a $5 wide vertical, which means the max potential profit, which is 126, plus the max potential loss, which is $5 width, max potential profit plus max potential loss, has to equal the $5 width, which means the most I can lose on this trade is $3.74, and that's because I'm collecting this up front. It's $5 wide, which means the most I can lose is $3.74. But that is an iron condor trade. We are just picking a range. We're not picking a direction. We are picking merely that the stock price will stay in this range for the next 30 to 60 days, however long our trade is. And that is what an iron condor is and how to potentially set them up if you start trading them.